Now we'll talk about debt investments. Okay, as you can see, we're already on part C here. There's only 4 parts. We're getting close. These chapters are getting shorter and shorter because so much of this is review for us, right? So let's talk about debt investments. Well, debt investments, I said, they're kind of the flip side, right? They're the flip side of long-term debt. Long-term debt being when we borrow money. Okay, think of this like one company lending to another company. Okay, but instead of just cutting them a check and expecting interest in return, we're going to purchase a bond, right? This is an instrument that represents debt. Okay. Okay. Bonds are incredibly important. If you're a finance person, you're going to learn a ton about bonds. If you are an accounting major, you are going to learn a ton about bonds in Accounting 301 and 302. There are a lot of different ways to account for them. They are some of the more fun accounting that we do. If you can call any of this fun. As an accountant, I think bond accounting is fun because we get to do our favorite thing, which is allocate a lot. So, but let's talk about the 4 critical events that happen when you purchase debt in another company, and specifically the events that occur over the life of the debt investment. Okay. So number 1, you're going to purchase that debt, right? You've got to purchase it. Number 2, you're going to receive interest. Notice this says for some debt securities. In this class, it's going to be all debt securities we purchase. Okay, you will receive interest, and typically you will receive interest semi-annually, and that's extremely important for you to know. Okay, you have to look out for these 2 words when you're reading problems. Okay, so be on the lookout for these. Have a bolo right out for these guys. Okay. Next, you're going to hold the investment during periods in which the investment's fair value changes. These are unrealized holding gains and losses. Same thing we talked about with equity, right? And then you will either sell the investment before maturity, right? This is going to be realized. Why is it realized? Because it's really happening, right? It's really going to happen. Okay. Or you're going to receive a principal payment at the date of maturity. So if you buy a $10,000 bond at 5% interest every year, you're going to receive some amount of interest at 5%. But at the end of the life of that, when that debt matures, when that bond matures, you get that $10,000 back. Okay, you've loaned it to them; they are paying you back. The interest is simply a representation of the cost of them borrowing that money from you. Okay. So in the following examples, though, we're not going to worry about number 3. We're going to walk through 1 and 2, and then the very last portion of event 4, okay, the receiving principal payment at maturity. Okay, we're not going to worry too much about selling the investments before maturity. I think that's a little deeper than we need to get in this class. We really just need to understand what happens when that debt matures. Okay. So when you record the purchase of a debt security, that bond, okay, this is what it's going to look like. And just keep an eye on this. We're going to keep this same fact pattern, I believe, through all of the examples that we work for this chapter. So let's just say on January 1st, 2024, they purchased $100,000 of 7% 10-year bonds for $100,000 with interest receivable paid semi-annually on June 30th and December 1st each year. Notice again, semi-annually pops up. This means they get paid twice per year. They get paid an interest payment twice per year. Okay. What this means is the bond on its face says it's worth $100,000. The interest rate we will pay you every year is 7%. We will do this for 10 years, at which point we will give you the $100,000 back. This bond matures in 10 years. Okay. This was our purchase price. Don't get it confused with this. This was not our purchase price. This just simply tells us what is par value, right? Par meaning what's on the face, right? Okay. So this was our purchase price. We get paid semi-annually, okay, on these dates, June 30th and December 31st. Okay. The bonds are issued at par. Notice it tells you that. Note here, I made this note. I really want you guys to pay attention to this. Pay special attention. It's not so important right now, but it will become important later. Okay. Semi-annually means that they pay interest twice per year. Okay. Make sure you catch that. Sometimes it'll say quarterly. Sometimes it'll say monthly. Sometimes it'll say biannually. Okay. Whatever the case is, right? Just make sure you catch that. Okay. So what's happened? Well, we increased our investments, right? You may name this investments bonds, okay, just to separate it from your investments in equity. And you've decreased your cash because you've given some cash away. You're letting them borrow this, right? This is the amount they are borrowing. And we'll just say they borrowed, okay? So you are losing cash, right? So you're going to increase an investment and you're going to decrease cash. Again, this is a net zero impact, right? So what happens when we receive interest revenue? Okay, so let's say on June 30th, it is now time for us to receive interest revenue. Well, this is where our ART formula is going to come back into play. Our amount times rate times time. Okay, so the amount was our purchase amount, $100,000. That's the principal. Times 7%, our interest rate, times 6 over 12. Notice this is 6 over 12 because it's semi-annually. Semi-annually meaning 12 divided by 2 equals 6. So you get paid 6 months worth of interest, right? That's why we use 6 over 12. Okay, and we're going to multiply that all together and we get $3,500. This is our interest revenue. Okay, so we're going to increase asset, our cash, right? And we are going to increase a revenue or gain. In this case, it's revenue. What happens when we increase revenue? Well, net income increases, which in turn increases our retained earnings. Okay, so any questions about that, please let me know. I'm happy to answer them. I know this can get somewhat confusing, but we've done this already, right? We've done this back in the day, except we called it interest payable. How much interest do we owe? Well, now we're just saying how much interest are we receiving? Okay, so don't hesitate to contact me about this one if you do have questions. Now let's say we hold the bonds to maturity, meaning we hold them for the entire 10 years, and at the end of that 10 years, they're going to pay us $100,000, right? How do we handle that? Okay, well, there are no expenses and no losses. We're simply going to receive $100,000 in cash, right? This is what we got back, or what they paid us, what they paid back, okay? That's the cash. So we're going to increase our cash, but we're also getting rid of this investment. We no longer have that investment, right, on the books. That investment, bonds, is no longer there. Okay, it's gone. We're going to decrease that, right? So pretty simple journal entry when you reach maturity. We're just increasing our cash and decreasing our investment. It is the flip side of that original entry that we made where we decreased our cash and increased investments. Now we're increasing cash, decreasing investments. So I believe that is it for equity investments and debt investments. Next, we'll talk about analysis, but that will go rather quickly as well.